Hello, everyone, and welcome to the Auditor Panel webinar. My name is Philip Bodie, and I am the Systems Compliance Manager at CLAS. I am co-hosting this webinar with Jason Russo, who oversees strategic partnerships at CLAS. Jason will also be showcasing our audit marketplace later on in the webinar. The CLAS Auditor Marketplace aims to connect leading SMSF auditors with SMSF administrators and accountants such as yourselves. And in this vein, we are fortunate to be joined by a number of industry experts. We have Mark Andrejic, who is a partner at Unison SMSF Audit Solutions. Unison is a specialist SMSF audit firm with an experienced team of auditors that deliver over 6,000 SMSF audits on an annual basis. Mark will talk us through valuation assessments, in particular valuing property, helping us navigate some of the nuances around when evaluation is required and what is considered sufficient market valuation evidence for an SMSF audit. We also have Shelley Banton, Head of Education at ASF Audits. ASF Audits is an industry-leading SMSF auditor with 25 years of experience. Shelley is an SMSF expert with countless technical articles in reputable SMSF newsletters. She will, in fact, be covering one of those topics, one which is quite topical, still evolving, and no doubt a challenge for the space: the compliance implications of holding cryptocurrency in an SMSF. And finally, we have Anthony Koen, Director of Super Know-How. Super Know-How are specialists in all things superannuation. They've been long-standing partners of CLAS from the very early stages and have been intimately involved with developing our flagship software product, CLAS Super. Anthony will provide some useful tips on how to ensure you submit a complete audit file for an SMSF audit. A warm welcome to all our panelists, and thank you for joining us today. Today's webinar will go for about 45 minutes. We have reserved some time to take questions in the last 10 to 15 minutes. Please use the Q&A session in Zoom to post your questions. You will find the Q&A module at the bottom of your screen. Please refrain from posting your questions in the chat as it will likely be missed. We will now kick off the conversation. Let's start with property valuations before we get into the murky world of cryptocurrencies. Property is one of the top 5 assets held by SMSFs. The ATO has provided some guidelines on valuing a property, but there still appears to be some confusion in the industry. Mark, as an SMSF auditor, what do you look for when auditing an SMSF that holds property to obtain appropriate and sufficient evidence that the property is carried at market value?
Thanks, Philip, and good afternoon, everyone. So, as Philip mentioned, I'll be talking to you about assessing assets in an SMSF. First, just want to start with why assets need to be valued. So if we look at evaluation of assets, they're required for a variety of reasons, including to confirm your SMSF has complied with relevant super laws. So think of acquiring assets between SMSF and a related party, investments made and maintained on an arm's length basis, disposing of collectibles and personal use assets to a related party, determining the market value of an SMSF's in-house assets as a percentage of all assets in the fund, managing your fund's investments in the best financial interests of your fund members, and preparing the financial accounts and statements of the fund, which I will talk to in a little bit more detail today. So Regulation 8.02b requires all assets of an SMSF to be valued at market value in the financial statements each year. So essentially that's all assets, listed and unlisted investments, managed funds, collectibles, other assets such as cryptocurrency and property. The valuation, importantly, should be based on objective and supportable data. And I'll talk a little bit more about what that means later on. But that really is the key to the valuation of assets. So for example, cash, pretty simple. It is what it is at year end. Listed shares, you have a holding balance and a share price. Again, easily supported. Managed funds, you receive a statement with the balance. Ideally, the managed fund also has a GS 007 report. And again, that is pretty easily relied upon. Does get a little more complicated and assumption based when we talk about some of those other assets such as property and collectibles. I just want to touch briefly on the valuer. So does this always need to be an independent expert doing your valuation? Well, not necessarily. The valuation process, rather than who conducted the valuation, will determine the appropriateness of the result. The valuation must be based on objective and supportable data, and you'll need to provide that information to your auditor. Trustees are not necessarily required to obtain a valuation by a qualified valuer in preparing the financial statements. However, you need to be aware that there are circumstances under the superannuation law where that is the case, and a valuation would need to be provided by a qualified independent expert. And we're talking about things like collectibles and personal use assets disposed of to a related party. You really should, however, consider using a qualified independent valuer if the value of a fund represents a significant portion of the fund's value, and the nature of the asset indicates that the valuation is likely to be complex or difficult. So think here about whether, as you as a trustee or someone advising a trustee, such as an accountant, can you obtain enough information to base that valuation on objective and supportable data? So when we look at things like collectibles and commercial property in particular, it is going to be quite difficult. Regardless of who performs the valuation, there are some general valuation principles that need to be considered. The trustees need to be able to demonstrate that the valuation has been arrived at using a fair and reasonable process. So it takes into account all relevant factors likely to affect the asset value. It's undertaken in good faith. It uses a rational and reasoned process, and is capable of explanation to and scrutiny by a third party. So you really need to be thinking to yourself, do I have sufficient evidence to support the valuation to provide to my auditor, or alternatively to the ATO should they ask for it as well, which we do see happens on occasion. I want to touch on property values, as it is the most common item we see in valuation issues for. So generally speaking, there's two types of property held by a super fund, residential and commercial. And regardless of the type of property, an assessment of market value must be made on an annual basis. Just looking at some of the valuation approaches, because they do vary across particular accountants and trustees. So trustees can consider a variety of approaches when assessing market value, the most common of which is the use of an independent valuer. Other valuation approaches can include curbside valuations, contract of sale for recent purchases, comparable sales, a rates notice, or net income yield of commercial properties. But with those last two in particular, you do need to be careful, because something like a rates notice, for example, on its own, it's unlikely to be sufficient for valuation purposes, as it will generally be the unimproved value of the land, and the timing of that valuation may not be appropriate for a 30 June valuation each year. So we really look at that being used only if it's consistent with other evidence that's been provided. Similarly, the net income yield for commercial properties, not sufficient on its own, and certainly wouldn't be considered appropriate where the tenants are a related party. Of that particular list on your screen, sorry Philip, generally a single item of evidence listed there won't be sufficient on its own unless the property has been recently purchased. So you'd be using some of those items there where you have other information. So if you've purchased the property in the last 12 months, maybe utilising a curbside valuation from the real estate agent or recent comparable sales might be sufficient. But we do suggest a variety of sources of evidence to support compliance with Regulation 8.02b. Real estate agents, similarly appraisals stating what the property is likely to sell for based on sales in the area. Again, we see that quite a lot, where you get the one-liner from the real estate agent saying this is what we expect your property to sell for, without listing the details of those sales and what that particular real estate agent has based that valuation on, wouldn't be sufficient on its own as far as audit evidence goes. The other thing there is the evidence provided should support a market value for the property as close as possible to 30 June, particularly where the market is potentially volatile as we're seeing currently. External property valuations. So if trustees obtain an external valuation, they don't necessarily need to have a valuation performed each year. The valuation should still include objective and supportable data, so the listing of comparable sales. So basically, the information that the external valuer has utilised to come up with the valuation. That should be included in the valuation report. The other thing to note there is gone are the days where an independent valuation has been obtained so it can be relied on for 3 years. We still see that a little bit now where an expert has provided a valuation back in 30 June 2019 and the trustees are still relying on that at 30 June 2021. It really does need to be on an annual basis, so you really need to look at what has occurred over the intervening period and consider things such as evidence of changes in market condition, rental market movements that may affect property pricing, improvements that you may have made to the property, changes to the character of the asset, and land value movements. So also just including a minute, for example, that the trustees have reviewed the value of the property and it's still considered reasonable isn't sufficient. They really need to substantiate why the valuation is still appropriate in their view. So in summary, it's important to ensure that you have valued all fund assets at market value on an annual basis. The valuation is based on objective and supportable data. And what we're really looking for there is recent sales history, other information that is pertinent to that valuation. And you need to provide that information to your auditor in support of the valuation's assumptions and methodology. Thank you, and I'll hand over to Shelley Banton from ASF Audits to talk all things cryptocurrency.
Thanks, Mark, and good afternoon, everybody. It's an absolute pleasure to be here today, and also thanks to class for the opportunity to be part of the panel today. You'll all be receiving a copy of my crypto fact sheet from class tomorrow, I think, but today we'll be going through some additional touch points on what to look out for with crypto in super funds. So a few quick basics. The ATO is obviously concerned about crypto in general and has issued warnings to taxpayers to make sure that they keep strict records to ensure that the tax being paid on disposal is calculated correctly. If we could just move to the next slide, please, Philip. Thank you. And obviously this means it's essential to ensure that the cost base is recorded each time crypto comes into the fund correctly, and that's regardless of how it gets there. So if you've got a staking problem with staking rewards program with only a very small amount of crypto coming into the fund, you still have to make sure that that cost base is correct. And one of the reasons is that the ATO is actively data matching to make sure that those crypto traders, which include SMSFs, pay their fair share of tax, because crypto isn't money, as we know, it's a CGT asset. We also know that crypto is a high risk speculative investment and it operates in an unregulated market and it has new ICOs every day, which means that anybody can raise that capital by offering a new cryptocurrency, including you or I, and we can provide that to the market tomorrow. So if Shellcoin wasn't out there, I could actually introduce Shellcoin as a cryptocurrency to the market. And during 2019, ICOs raised $14.8 billion. And on any given day, there are an average of 482 ICOs open. So each one of these raised about an average of 11.5 million. And unfortunately, only about 1/3 of these ICOs get completed over the year. So this means that there's a lot of pump and dump scams out there where the scammers talk up the value of the ICO, they generate that interest, and then they dump the coins for profit. And what we do is we get a little bit concerned at audit when we see a deposit being paid out of the fund for a new cryptocurrency, and then it just sits there on the balance sheet for a couple of years, because our auditor spidey senses starts going into overdrive, because it could well be the case that the trustees have been scammed and they've effectively lost their money. The other issue we see on the balance sheet is incorrect classification of crypto. And I've seen this classified as cash, foreign currency, foreign assets, unlisted units, unlisted unit trusts, and also listed shares. Now, we would expect to see that listed as either digital assets, maybe other assets, crypto, or even just cryptocurrency. And we get very wary about classification of crypto because it can have repercussions not only for trustees, but for SMSF auditors as well. From the trustees' point of view, they think that they've got less volatile assets in the fund than it actually does, and it can affect their investment decisions. And given the auditor litigation case on the other side of the coin, the problem of asset miscalculation was one of the biggest issues in the Camembert versus McGoldrick case. And it's another reason why we're going to review that cryptocurrency carefully and make sure that it's classified or correctly and reclassified where it's not. Another issue that we see at audit is where the trustee has multiple wallets and the amount of crypto on the balance sheet doesn't reconcile with what's in the wallet that's been provided at audit. So obviously we hold up the audit, we need to query it, and usually there's other wallet details that we get given, and then we can give a particular approval. So just make sure that it reconciles with the wallet, what's on the balance sheet, and we're given all of those information up front so that we're not delaying the audit any more than we need to. So of course, a fund can invest in crypto as long as it meets what I call the golden rule of 3, which is it's allowed under SIS, that it's allowed under the trust deed, and also the investment strategy. Now, in terms of the trust deed, the governing laws should be reviewed to ensure that the trustees can invest in crypto, or at least the trust deed doesn't explicitly exclude it. And most times we just see this generic clause that says trustees can invest in any other allowable asset allowable under SIS. But have you thought about the risk management side of things? Because under section 55 of SIS, it says that where a person suffers a loss or damage from investing in an asset not covered by the trust deed or the investment strategy, action can be taken against those involved in the contravention, which can include financial planners, accountants, and auditors, to recover that amount of the loss or the damage. So you need to be very careful about how much assistance you are providing your clients in terms of setting up these important documents, such as trust deeds and investment strategies, especially if you're not licensed to do so, and making sure, of course, that they take into account all of the assets, the risks, the liabilities, the rewards, the liquidity, and so on, all of those definitional elements under Reg 409 of SIS. Now, the main compliance breaches we see are around identification of the other party on the transaction, as well as what the nature of the transaction that's been undertaken. So it can get very complicated because we're often seeing trustees chasing these returns without really having an understanding of how crypto and digital assets really work. So the types of questions we're going to ask, is it a related party transaction? Is it a contribution? Well, it can't be because it's not money. Has the fund lent money or provided financial assistance to a related party or a relative? Has the fund borrowed money? And has there been a charge given over the assets of the fund? And I just want to quickly discuss the last 2 breaches here, because they're the ones that we're going to be seeing a lot more within cryptocurrency. Now, if we look at some of the cryptocurrency trends that are happening, we know that crypto has a bit of a language all its own, and I'm no expert, and this is where Google comes in, because what we do want to understand is the nature of the transaction and whether there's a breach or not. So things like staking, airdrops, using GameFi or DeFi, they may not result in a compliance breach, but it depends on the nature of the transaction. So if a trustee deposits crypto with an exchange or a service provider on the DeFi platform, or they lend funds to them through a staking rewards program, that may in and of itself may not be a breach. But once the fund starts to borrow, it's a breach of section 67, and there's a whole lot of combined services that are now on offer in relation to staking programs. And so we can have a transaction that quickly changes from being a compliant one to a non-compliant one. There can also be a breach of Reg 1314 of SIS if the trustees deposit crypto with their lender as security for borrowing. And usually they do this to borrow fiat currency to buy more crypto. And they can also breach Reg 1314 if they provide crypto as security for investing in crypto derivatives as well. And we know that while a fund can invest in derivatives, those exemptions are available to it under SIS, and they only apply to those transactions that are undertaken on approved bodies in line with Schedule 4 of SIS. And none of that list includes any cryptocurrency exchanges whatsoever. The main problem with it all is that the lack of documentation we're going to get at audit, because the clients are simply clicking on a button on a website to enter into these programs. They usually get very little information back, and what's on the website usually disappears once they click onto it. And of course, once the horse is bolted, it's a little bit too late. So maybe letting your clients know to take as many screenshots as they can along the way will help reduce the amount of queries and potential breaches at audit. And what's also important here is that I keep getting asked questions about, is this platform compliant? It's not a point of endorsing a specific platform. It's about what the trustees are going to do with that crypto on that platform, which is the important issue. And while we're seeing these cryptocurrencies developing very unregulated synthetic financial products, we're going to see a lot more breaches that are going to be identified, but not until audit. So it's really important that clients understand the ramifications of their decisions on these crypto platforms, regardless of the platform that they're using. One of the biggest headaches is going to be when the trustee dies or they lose the passcode to access the wallet, because typically that private key and the password to access the wallet are really only known and stored by the user who set it up. And once that's gone, there's absolutely no getting it back. It's lost forever. In fact, Chain Analysis, which is a crypto data firm, has estimated that about 20% of all Bitcoin is either lost or stranded in wallets. So I guess as much as you hate banks, at least you can eventually get your money out if you lose your PIN at the end of the day. And that's where obviously documenting and sharing this information is critical, because it's important to ensure that all the details can be passed on to somebody else in the event of a significant event, and make sure that assets are kept secure. Lastly, what about what you can expect to see in the audited report management letter? Well, where crypto is a material asset on the balance sheet, we're obviously going to qualify Part A of the audit report, because we're not going to be able to determine whether there are any material misstatements in those financial statements in relation to crypto. And the reason for that is that the qualification is that we can't rely on the reports that have been provided at audit, because they're not audited. They are unaudited platforms, so please don't be surprised if you're seeing Part A qualifications with crypto in the fund starting to creep into your audit reports. In relation to the management letter, well, there may be comments there which will depend on fund to fund. You may see a comment in there in relation to security of fund assets, which we've already touched on. And we know that that's a critical issue when we come to securing crypto and the wallets. So the comment sort of may be along the lines of the trustee may wish to consider documenting the fact that the exchange and the wallet details have been securely put in place, so that those details can be passed on to the trustees and the beneficiaries in the event of death or otherwise. So it's not that your SMSF auditor wants those details, far from it. We want to make sure that those procedures have been put in place so that those details can be passed on to somebody else in the event of something happening. That's the end of my session. So I look forward to answering any questions you might have at the end of the panel. And also don't forget to head to our website, ASF Audits, for more articles on crypto and NFTs. But for now, I'm going to hand the conch over to Anthony, who will be concluding our panel discussion today. Thanks, Anthony.
Thanks, Shelley. So good afternoon, everyone. My name's Anthony Koen. I work for Super Know-How. We're a small Australian firm specialising in SMSF accounting and audit work, which we've been doing on class for over 12 years now. All of our staff work from their homes in New South Wales and South Australia, so technology is something that's been pretty big for us to get right. It's something that I will mention a little as part of how Super Know-How has tried to make sure that we don't miss giving documents to our auditor. Before I get in too much further, I think it's worth mentioning that we aren't talking about every single fund we audit here. For me to start mentioning things like common items or things that need to be asked for often will almost certainly sound far worse than it really is. As far as our audits are concerned, we track the figures of how many are sent back for queries, etc. And we know that the first audit usually has a bunch of queries the first time we pick up a fund. But it does get better each year after that. Even if the items that an audit is sent back for are small, they all add time to the process. So they cost money or time for everyone else. So lower costs or less time spent on the work helps our the profit margins for everyone involved. So it's something that I assume we're all keen to have a look at. And so eliminating any situations where an audit query is unnecessary can hopefully speed things up, and they do quickly add up as the number of funds that you're sending to your auditor increases. So I think that we can break down the question of what are some of the common items missing when submitting an SMSF for audit into two general parts, the financial audit and the compliance audit. Now, the use of class and all of its automated features significantly reduces the number of issues that arise in relation to the financial part of the audit. We do the accounting for a number of funds, and we found, though, that despite all of the automations in place, we still make mistakes every now and then, and find that these same kinds of issues are experienced by our audit clients, and that were causing us to have to send audits back for a small fix or two. Now, we've worked with class since while the software was being developed and first released, so we really know it intimately, and we know how to pull all of the information out of it. There's a whole bunch of APIs that you can extract information out of class. So to try to make things a bit more efficiently, work a bit more efficiently, we built some checks that go and pull information out of a whole bunch of class reports to look through those to identify potential issues with dates of prices, cross-checking reports, etc. You can also set up checklists to do essentially the same kind of stuff. Once we got it working, that's something that we found some real benefits for in picking up a bunch of the problems that you can see on your screen that I'll run through in a second. And that's something that we provide as the first part of our audit. When someone sends us a fund to audit, we've got an automated process that generates that or goes through those checks and says if there's anything that looks a bit iffy, so that it can be looked at and fixed, so we don't necessarily have to send an audit back if it can be avoided. So the kinds of things that are commonly missed processing-wise in class are things like forgetting to run period update. If your auditor is going and looking at the info in class directly, then you may potentially make a fix, something like that, forget to run period update and send the audit over. Forgetting to obtain an actuarial certificate. So looking at making sure that if you've obtained it and you didn't use one of the providers that automatically put the actuarial percentage in, making sure you've put it in, rerun period update, etc. Not all assets are revalued automatically in class. It's easy to get used to share prices and managed funds and stuff all being priced for you automatically, and you don't have to do very much for it. But things like properties, unlisted trusts, unlisted companies, they will all need prices to be entered by you. And sometimes even some of what would ordinarily have automated pricing may need you to step in and make a change yourself. So shares become delisted, and if they're still showing up at their last traded price, they might need a fix, and things like that. Not all of the bank accounts that you may have in class have automated feeds, so remembering to go through and tidying those up. Sometimes the tax accounts may be something that the client accidentally goes and pays a PAYG installment or a tax payment personally. So making sure you've looked at those reports and entered the info into class. Distribution tax statements is something that can be forgotten. They do pop up in class in the exceptions report to remind you if it looks like you've missed them. But because they're not a cash item, it can be something that is missed. And similarly, some of the corporate actions, the ones that don't have a cash component, it's not something that pops up on the match transactions page for you while you're in class. So it can be something that you do miss out on. Two more is the June PAYG installment. Again, happens after the 30th of June, so might not be something that you've processed. And checking through all of the pension accounts to make sure that pension payments have been allocated such that all of the pension accounts have met their minimums. So that's a lot of a lot in that list. They probably get less frequent as you go down the list, but you can see that the pattern is that things like bank fees, broker fees, wrap fees, they all do a really good job, and the processing that relates to those items is great. It's the non-standard things that start to happen that are more likely to get missed and need some kind of checklist or other thing to make sure that you do process them. In particular, we're talking about things that don't have a cash component that aren't going to appear on the match transactions page for you to complete. In terms of documentation in relation to these items, the thing that's probably the biggest issue right now is what Mark went through already is property valuations. So won't go into too much about that, other than to say, make sure that you provide the sufficient appropriate audit evidence so that we can check the property value and not have to send anything back for the audit. On the compliance side, for us, the compliance audit starts with permanent documents. They are probably the first things that we find are often not provided as part of an audit, and it's usually the very first audit. Clearly, most of the time, they're not things that you need to ask for every single year. You hand them over once, and it's expected the auditor hangs on to and doesn't need to ask for them every year. So it is easy that if you've changed auditors, you might go, well, I didn't provide it last year, don't need to provide it again. But if you change auditors, you will. So we're talking here about things like member applications, trustee consents, ATO trustee declarations in particular. Usually the trustee and the investment strategy are not forgotten there and are usually provided as a matter of course. The compliance audit of the fund's investments is harder or easier depending on the investments owned by the fund. So the more complicated the investment, the more information that we're going to need to ask for. And if the investment is related, then we're probably going to need to ask for a little bit more again. These are the things that we're usually given reasonably little documentation to ask for. They often lead to needing a couple of rounds of requests because you provide a document and then we have to go and notice an issue with it and ask for some additional info. So what we're talking here is what we would call non-standard assets. And so we're looking at, for example, for collectibles, a picture of the item, a recent valuation, insurance to see where the item is also located. That's usually on the insurance, as well as any other items that the ATO requires about confirming where it's stored and why you're storing it there, etc. Even though the transitional rules for collectibles ended quite a while ago, the documentation to confirm compliance with the new rules isn't necessarily being provided up front. For bullion, so we're talking here, gold, silver, etc. The easy cases where it's held by someone like Perth Mint. Unfortunately, it's the cases where the trustees store at home that you're going to need to provide a bit of additional information, things again like photographs, confirmation of insurance, etc. Maybe a stat deck as well. For loans, while the Baumgartner case was probably as high profile as you think things could get for SMSFs, we still run into issues trying to obtain enough audit evidence to be able to provide reasonable assurance that a loan will be able to be recovered. So is it secured, is it not, etc. The end result in a lot of those cases is at least a Part A qualification because we're not going to be able to get all of that info. Unlisted trusts and companies can be a bit of a rabbit hole. In particular, though, I think we can sum things up to say that trustees often don't understand that under certain circumstances, we're really almost having to audit the underlying trust or company in order to provide them with reasonable assurance that the underlying assets are valued correctly, that no money's gone astray, there aren't any charges over the fund assets, all that aren't allowed, etc. So while we're usually given a set of accounts, it's the things like trust deeds, bank statements, loan statements, title searches, leases, and all that kind of stuff that we need to be provided with, depending on the ownership of that asset. But it's something that we might need to ask for in order to provide the reasonable assurance that we're supposed to, both for Part A and Part B. Okay, so next slide there, I think should be the last one. So like I noted at the start, it's worth mentioning that we aren't talking about every single audit that we do here. There's a good proportion that go through straight up front. The work gets better every year, but the things that that we normally find are the things that are going to hold up the audit, non-standard transactions, and in particular the non-cash ones, non-standard investments, and they're what are generally going to result in us asking for more information. And the more complex it is, perhaps there's more than a round or two of needing to provide information. That's it. I'll pass over to Jason to have a run through the audit marketplace.
Thanks very much, Anthony, and thanks to all of the class audit partners for your presentation so far. I'm just going to share my screen now so that I can walk you through a quick demonstration of the auditor marketplace. Okay, we can see that. Okay, so very, very simple. In order to get into the class audit marketplace, you really only need to have two really clear steps. The first one is just to move over to the class website. You just want to hover over the Partner Center tab, which will bring you down the auditor marketplace. Once you click on that, you'll come into the section that will list out the auditors and find the form which is required for submission a little bit down the track. Now, the idea here of the marketplace is obviously to connect you with some of the leading SMF audit specialists, some of which we've certainly heard from today. And our last presenter also did a really good job of kind of highlighting how seamless kind of the interaction and the flow of data can be through the class suite of technologies into the auditors. So this panel here, they'll help you to streamline your compliance processes and hopefully help you deliver exceptional client service while maintaining your business compliance. Now, there are 6 auditors in the audit panel here: ASF Audits, BDO, Deloitte, SMSF Auditing Australia, Super Know-How, and Unison SMSF. Under each of those, if you like, you can click on them and read a little bit more information about their offering. Each one of them will have some information for you there. If that's not important for you, when you already know who you would like to speak to, you just move down to the bottom of that list of auditors to a section here which will allow you to request a quote. Quite simple here. You just need to put in your contact details and then just select which auditors you'd like to hear from. This might be 1, it might be 2, it might be 3 of them, your number of funds, and ideally your class business code. Once you submit that inquiry, that'll get off to each of the auditors that you select, and they will then come back to you with some follow-up questions in order to offer you a detailed quote. That's all for me here in the auditor marketplace. I'll just pass back now to Phil for our Q&A.
Thank you, Jason. We now have some time for some Q&A. It looks like most of the questions have already been answered. There is one that's still open. Looks like, Mark, you are addressing it. Do you want to take that one live?
Yeah, I can talk to that one. I was almost finished typing my answer, but that's okay.
That's fine.
The question was around if an SMSF has commercial property and has an external valuation in the 2021 financial year, can we keep that valuation the same for FY22, or do we need another property valuation? There was also a question about what about if the auditor requests for a property appraisal every year? Or I guess I'll answer the last one first, because unfortunately, if the auditor requests something, you probably need to have a discussion with them around why that request has occurred, because they need to have, I guess, be comfortable that the valuation is still appropriate. So generally, if an auditor is requesting something, there's a reason for that, and you can't, if you just said, look, I'm not providing it, you probably will end up with a qualification potentially. Overall, though, you can keep that valuation the same. However, you do need to, the trustees will need to make an assessment as to whether there have been any changes or any evidence that there may be changes in the market values. Commercial property is a little bit more difficult than, say, residential property, because commercial property doesn't have a lot of movement. There's not a lot of sales evidence. So you'd probably need to be looking at things like, is there a lot more vacancy rates this year than last year from a rental point of view in that area? Because that might be an indicator that the value may go down on the basis that if you're looking at the yield, for example, you wouldn't get as much rent, so the valuation would go down. So as I said, things like what's vacancy rates look like? Have they changed? Have they improved, gotten worse? If there has been commercial sales in the area, that would be something you would look at. But overall, looking at some of the statistics as well in the marketplace. So it's not as easy as just saying, yep, we've received a valuation for FY21, we're going to carry that forward. You need to be able to justify, are there any market conditions that would impact that valuation, and to be able to articulate what those things that you've assessed are and the outcome of those.
Thanks for that, Mark. This is a bit of a general question. If a Part A qualification is issued year after year because market value evidence can never be obtained, are there any implications? I'll throw that to you as well, Mark.
Yeah, look, I mean, it would be a tough one. Yeah, you may end up having a contravention there as well, because if you have a Part A qualification because you can't provide market evidence, then that suggests that the property isn't at market value, which is a requirement under the legislation. So you'd almost sort of wonder whether the first year that's a bit of a warning, but I tend to see the two go hand in hand. If you have a Part A qualification and it's material, then it's unlikely that that's going to be at market value. So that would be a contravention potentially as well.
Mm-hmm. Thank you. And it looks like the participant has actually clarified that the question related to private company shares.
Company shares. Yeah, again, that's you probably it would need to look at the materiality of that and whether it meets the requirements under the legislation for when a contravention would occur. But I mean, even if it is a private company, there is a way to value private companies based on whether it's the from an income point of view or whatever the case may be. That's a cost benefit question as well. But I mean, I'd sort of look at whether if it is difficult to get that valuation, is that an investment that the trustee should be making as well, because they don't necessarily know the value of their fund on an annual basis. There's probably a couple of considerations in that particular item there if it's ongoing.
If the members are in pension mode, there might be an issue with the pension not being valued correctly and paid correctly. If there's an ongoing issue with the private company shares not being valued, depending on how those shares got into the fund, it may also be an in-house asset issue. And so if you're not valuing those shares correctly or not attempting to value them correctly, it may well be an issue that you're trying to sort of circumvent the in-house asset rules potentially at the end of the day. So it does have broader implications. Whether the ATO, and maybe this is what the question is also asking, can the ATO glean anything from these Part A qualifications? And I guess we know that first year engagements for Part A qualifications have been taken out of or are no longer needed to be reported on the tax return. But what's the ATO going to do with this Part A qualification, with all this other data that's coming through? Because really, at the end of the day, for Part A qualifications on the tax return, they just end up with a whole lot of data soup. So are they then trying to data match that with assets that are in the fund? Are they, what are they trying to do? They have come out and said that there isn't, at this point in time anyway, they're not looking to undertake compliance action if there's just a Part A qualification on the audit report. But you may want to consider year in, year out, there'll be an issue. And as Mark said, that may well lead to a compliance issue. And certainly at one point in the future, there will be some, more information and more, data themes that they'll be able to get out of that information and potentially come back to trustees on Part A qualifications. But at the moment, they've said there aren't any compliance activity being undertaken if it's just a Part A qualification that's been reported.
Thanks for that, Cheryl. That appears to be all the questions we've got. So unless there are any further questions. All right, thank you to our panelists. Some excellent tips and insights all around. Thanks to the attendees as well for making time to join us today. We hope you find this webinar useful and hope to see you in our next webinar. Thank you.